So we're looking at a little bit closer with the euro dollar daily chart. I'm zoomed in a little bit here, just highlighting again the May to October time period. Seeing the euro. Now, this line here is that buy side liquidity pool. I mentioned that we would probably be up there around Christmas time. Now, at this time of the recording, we're higher than this here, but the draw on liquidity was this level here initially. So we always have to see if there's market structure to support a continuation once a target or terminus is reached. But we can see the bullish seasonal tendency, and right in here we were looking for the likelihood of it trading higher. It ran down below this old low here, and we were studying that real time as it happened. So the buy side liquidity resting above this relative equal highs on the daily chart. Again, I drew your attention to that back in the early parts of 2020. And again, this is your breaker, and this is all daily chart derived. And 1, 2, 3, all consecutive candles. You have to incorporate that as your PD array. Now you can refine it in certain instances, and again, that will be outside the scope of this lesson, but order block theory and breakers are an order block. The idea is we have to consider all consecutive candles that would make up one specific order block. And since we're looking at the daily chart, you have to incorporate all of these candles as the bullish breaker. So we have a low, high, lower low, sell side liquidity taken, and the market rallied back up. Notice the sensitivity here. Trades back lower, back down to the old low, whipped one more time below it, kept the low intact, and then we started to see an appreciation on the upside. So this level here is the low of the breaker and the high of the breaker. So we have a stage here with this scenario. In this area here, we would expect to see some more accumulation. It does not need to trade to the low of the breaker. It does not need to do that. We're going to take a look at this area in here with this context. So the buy program is that we are expecting price to trade from here up to this level here. And we want to study every single day when we look at euro, is this pair signaling or indicating that institutional order flow is in fact bullish? How do we do that? We look at up close candles. Are they being pierced effortlessly? Are they being traded through? That means if bearish order blocks are being broken to the upside, and specifically every down close candle that would be a bullish order block, is it supporting price and sending price higher? If we see those two signatures with what has already been outlined so far in this video, you have determined institutional order flow as bullish. You're within a buy program and you have a target, so you know where it should likely begin and where it likely will draw to. So between these two price points, you now have the narrative. Focus on that. So let's take a closer look at this. Now we have our focus on short-term bias. From the beginning of the buy program, we're looking at this area here running up into mean threshold, bearish order block, last up close candle, potential rejection block, and the old high. There's your premium arrays within this range. So you have to be mindful of that as it trades up into it, because it could have easily went through it, but you have to consider the likelihood that it may need to retrace, consolidate, or potentially reverse altogether. Nothing states that this move here to here is going to happen with the likelihood of it not failing. Okay, there's always a possibility of failing. That's why we have to have stop losses. Stop loss orders are there as our shield because our analysis may be wrong. But we have reduced the market down to a specific element in analysis where the short-term bias is derived as bullish. And once we have that, we can focus in on how the markets trade going into up close candles to the left, and are they finding support in down close candles? Every time we dipped back in, it supported more price advance on the upside with these down close candles. The market rises up, and then we have consolidation. Small little retracement, then price resumes higher. Every down close candle is finding support. Up close candles are being broken. Down close candle here, extend that out in time. Is it breaking down close candles? No. It's finding support of them and breaking up close candles. So your institutional order flow is bullish. Every time we have a down close candle, anticipate price movement higher afterwards. We do not lose sight of to the goal or the terminus here for the trade idea. So the structure and stage that we framed for this movement is enough to start building in the expected outcomes for each level of the algorithmic order flow hierarchy. So we're looking at this area here as short-term bias, and it's being bullish. While you have a short-term bullish bias, that means every single day you would go in looking for reasons to be a buyer. Now here's the thing. I want you to look at how many times we had down close candles and how many times we had up close candles. And also notice how much downside was offered with down close candles on the daily chart versus the up close candles on the daily candles. You have more magnitude on the upside. While you had potential to lose if you traded every single day and getting stopped out, that's fine. But look how many winning opportunities is offered once you strip the marketplace down to this in terms of short-term bias. But it has to be referred to in all levels of the hierarchy. Dropping down into the 4-hour chart, we're going to talk about the last level here, which is the state of delivery. In this area here, we have our first run on buy side liquidity over here. So the state of delivery is on buy side. So what does that mean? The candles are expanding on the upside with the expectation to run into levels of buy side liquidity. Now that might be sounding pretty obvious, and what's the big deal about that? It's important for you to start looking at how the market does this, because there's going to be a change in the state of delivery. And I'll explain that now. We have an initial run up into an imbalance here. Then we drop with the state of delivery is now on the sell side. So it's expanding on the downside, but it's reaching for sell side liquidity. That would be resting below this swing low here and inside this buy side imbalance, sell side inefficiency. This would be institutional order flow entry drill or potentially consequent encroachment of this buy side imbalance, sell side inefficiency. When you have a change in the state of delivery, that means you have buy side, then it goes to sell side, but it's opposing your underlying direction, which would be up here. Okay, you're thinking later on at some undisclosed date in the future, price should be up here, okay, or at least drawing towards that direction. When we have a change in the state of delivery, that's when opportunity is born. Look at your PD array matrix. You have this entire price swing here, and we cut through candles. We're not supply and demand. What's over here? It's a bullish breaker. We have the low, the high, and the lower low. The last up close candle, and it's only one candle here, extended out in time. You can see the movement back down into that bullish breaker. And at the moment when the state of delivery has changed, but it's changed to an opposing state of what we would expect in our price run that we're anticipating running from the beginning of the buy program to the terminus. So we have a very high probability setup, but you're framing it on the context of where the state of delivery changes. We have buy side, which is in the direction of our trade. That's what we anticipate. But if we start seeing a run back down into sell side here, and then we have a bullish breaker, or it could have been an order block, or it could have been just a standard optimal trade entry, which alone, that's what this is here. You have a high probability setup forming on the basis of fleshing out algorithmic price delivery. So the order flow algorithmically is likely to see high probability setups with these signatures. All these factors coming in gives you this. Your institutional order flows, which you're trying to seek. You're trying to determine what that is. And it's the underlying direction of inflows at the institutional level orders. It is the highest probable direction of the delivery of price on the majority of near-term candles. That means once we have this here, between that and where you think IPTA will likely draw to, in other words, where's the draw on liquidity? That's what we have up here. Well, this was not just this one. We were looking for a potential run above those relative equal highs. So we have the breaker low. So we have a PD array here. Is it a surprise to see it stalling here and consolidating? No. This would be a level where it should do what? Accumulate more longs. And this is a 4-hour chart, so you can start seeing this whole fractal here. If you look at this area here on your own charts, and I'm going to counsel you to do that for your homework, this area in here with that bullish breaker low from the daily chart, you'll see this same type of fractal in here on lower time frame charts. So you can see the beginning of the move here, trading up to this level here, consolidating. We talked about how understanding when the market consolidates, and I would start teaching you how we can anticipate those times and periods. This is how you start to see these things. When you have a level reached, basically, as we have here, this is where we should see buying occur. But the market has already rallied up to that. But we shouldn't see any real retracements because it's underlyingly bullish, and we've already had a run in here, and we already had a run in here on the sell side. So it's not necessary for it to be here and then drop down into this level here. It could. There's always the likelihood of that happening, but it's not likely, or let's say it this way, it's most likely that it's just going to consolidate here versus retrace. Then the market rallies again. So every down close candle is supporting price on the upside, and every up close candle is being broken, showing you underlyingly bullish institutional order flow. IPTA will look to initiate significant price runs when the institutional order flow is directional and when the state of delivery has changed into opposing order flow at a key PD array. That's here. Then this is the other one where we consolidate. It doesn't look like much here because I'm showing you the entire price run here. But if you looked at this on a 15-minute time frame, this is, it's not a lot of movement in here. It's only like 40 pips of consolidation. And then it starts to run again. The main takeaway is I'm giving you the building blocks, the foundation to understanding when the market's going to consolidate, when it should expand. But when are these high probability setups going to form? Because if you don't know what the algorithm is likely to do, if you don't have some reference points of how the macros start operating and the delivery of price is initiated, then you will never understand how to read the tape. You won't know how to see the next setups form. You'll always be surprised or trying to catch up. This evolves over more lessons. Okay, so I'll talk more about this and we'll flesh this whole thing out a little bit more on the weekend edition lesson. Again, we're not talking about market analysis right now because it's during the holiday season, but I'll give you another level of this teaching here. We'll go deeper into it, and I'll also talk more about the state of delivery and what that means, and we'll talk specifically about the order blocks and how that works within the context of institutional order flow. But for now, just know that there is a specific hierarchy that we break down with algorithmic order flow. There isn't a lot of moving parts with algorithmic theory, but there is a lot of experience needed to see it and appreciate it. When you watch me work with 1 minute charts and I'm working intraday, buying and selling, buying and selling, and buying and selling, that all stems a lot from this. Okay, so understanding algorithmic theory, while I'm not teaching you every aspect of my personal algorithm enigma, I'm going to give you a lot of study points that'll help you grow in understanding about how you can work with all time frames. I don't want you to feel like your model only works with the time frame that you like right now. The highest form of your analysis and the aptitude that you're striving for is seeing your model work on any time frame. And that gives you a lot of confidence, and it gives you a lot of flexibility. You don't have a setup right now for swing trading? Okay, fine. Look for it on a short-term basis. You don't have it as a short-term trade? Okay, let's go into it as a day trade. Okay, maybe you missed the ideal scenario for the day trade entry. Well, let's go into the sessions and work the individual sessions. Okay, you missed the ideal entry for that particular session. All right, let's look at a scalp as an entry. Institutional order flow entry drill. Okay, that's your last weapon. It's not chasing price, but you're learning how to see opportunities, not chase them, and also be able to form fit your specific model. But you start with things like this that give you a foundation. And then it gives you a great deal of confidence because you watched me outline all this stuff. But the basis behind all of it was this. The things I'm looking at is what I'm going to be teaching here. It'll give you a greater appreciation for why price does what it does and when it does when it does. Okay. And it sounds like, what did you just say? It basically, until you see it, it won't really make sense. Okay. So just know that this is a foundational lesson, and we'll build on it for daily routines and what we're looking for. Okay. How we go through the process of breaking the charts down. What specifically are we looking for? When I say I'm looking at things algorithmically, this is what I'm referring to. This is the elements that I'm talking about. We're looking for the 3 PD arrays that are premium by nature. That means they are PD arrays above the market price down here if we're underlyingly bullish. As it is in this example, we're going along with what we were looking for at the time. But I'm going to flesh out a few things here and ring in some things as well, so you can see how the algorithmic order flow works in concert with IPTA's PD arrays. So from here up to here, we're working with a bullish bias. So let's study how we can forecast likely areas where IPTA will create a change in the state of delivery. And how we do that? Well, I teach you a concept in this mentorship called grading a price swing. Okay, so we're forecasting a price move higher. So if we're thinking it's going to go to the rejection block, which is what I'm going to use in this example, it could just as well have been the mean threshold or the bottom of the bearish order block. That could be your terminus. That's the end of where you think it's going to go. That's like the safe bet. The bottom of the bearish order block. Mean threshold is a medium type target or objective for terminus. And then rejection block is just to make sure you try to get the best of the move without running out the high. Okay. Now, again, we were looking for this move here anyway, but we're going to err on the side of caution and show you how you can frame it with using the rejection block and not anticipating, obviously we were expecting, but not anticipating the run above the old high, because there's many times that price will fail to go above an old high, but many times it'll go right to the rejection block and offer you the ideal exit. So with this range in mind, I'm going to add the grades of my price swing from here up to the rejection block. Let's do that now. So here is the buy program, and here is the first grade at 25%, 50% grade, 75% grade, and then finally terminus here at the rejection block. Now on this time frame, it's not terribly interesting, but if we drop back down into that 4-hour chart as we were looking at in our last slide in the previous lesson, let's do that now. All right, so we have our chart trained in on the 4-hour chart for euro, and again we're assuming that this is the beginning of the buy program, and then we have the market breaking market structure here, and then we create an imbalance right there. So that's a buy side imbalance, sell side inefficiency. So when it goes above this high, that is a change in the state of delivery. What is it doing? It's running to buy side liquidity. Then it runs up, fails to get above this high here, but then trades lower back into the imbalance here and back into this area of old order flow. This is your breaker. It trades down to it here, but we can anticipate a new buying opportunity in and around that 25% grade. Okay, so all I did was taking a fib from the low here up to the projected rejection block. So that's the range I'm working within. It's an unrealized range. In other words, at this point here or even here, it hasn't traded there. And even in this example in fractal, you can see that it didn't actually trade up to the rejection block. It went to the mean threshold. And then here's the bottom level or low of that bearish order block on the daily chart. So there's our 3 levels here, 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 and here. So you can see how the market traded respectively. But look what's happening a little bit closer. When the market retraces lower back into this old area order flow and comes back in contact with a bullish order block in the form of a breaker. That's this last up close candle. It's filling in this imbalance here, trades down to it here, and then what does it do? It changes its state of delivery. What is it changing to? A run on buy side. Whereas it was running here on sell side, it hits a level that would constitute a potential change in the state of delivery. Why? It's mitigating at that price point because breakers are mitigation. What does that mean? Anything that was held short from here that was not taken off prior to this run here, institutions will be allowed or permitted the opportunity to mitigate that loss. Now, they may not get out even. They may not make a profit. It's not important for that to occur. It's just to reduce the overall exposure and risk and clear their positions at as close as they possibly can to the point at which that would be the minimal, not exiting their positions at a maximum loss or while it's running away from them. So we have mitigation here after rebalancing the buy side imbalance here with the bullish breaker. Once it hits that, then we can anticipate. Now here's where tape reading comes in. The assumption in this example here, in this teaching, is the rejection block is the draw. But with the mean threshold of the bearish order block, look at the bodies of the candles respecting that mean threshold. And in this darker line here, extend that out in time, that's just the bottom end of the bearish order block or the low. Okay, so you can see there's the difference between all three of those PD arrays. But using the draw on liquidity that would be ran to, which eventually it was, but not in this study, it did get to the rejection block and went higher, obviously. But as long as it's moving in that direction, that's order flow. Okay, we're staying with that narrative until something obviously tells us differently. It ain't going to go there. But 25% of that grade, what does that mean? From the low up to that rejection block, we split this up into equal parts, and you do that with a fib. And the way you can do it without having a fancy dance your fib is do a low to the rejection, find the 50% level, and draw that out here. Then pull your fib from the low up to this level here, and then it'll create a higher 50% level, which will be right there. Then drop a line there, and then drag that fib back down, and then pull it from the rejection block to here, to this 50%. And what that'll do is give you a halfway point between this level and the low, and that'll be here. So 25 is 50% of this in this. 50 is half of this low and the rejection block. And 75 is half of the midpoint or half of the projected range from low to rejection block. High or rejection block to midpoint, you'll get to 75%. Okay, so there's your grading of a price swing. So at the 25%, we see price trading down below it after it trades above it, trades to a bullish breaker here. And then we have what? Displacement. We have an imbalance right there. And notice it goes here and starts to trade back down at the 25% grade, and it goes into consequent encroachment of this buy side imbalance, sell side inefficiency. At this point here, has it fully taken buy side liquidity out? No, it hasn't even gone above this high yet, nor has it gone above this high, leaving relative equal highs. So when this retraces down like that, we are not looking at this to completely collapse. We're looking for it to come back down into this buy side imbalance, sell side inefficiency. So what's happening here? The buy side is changing its state to sell side, going into an old imbalance where it was buy side previously. So what is this lesson showing you? It's the changing of the state of delivery. This is where the opportunities form algorithmically. When the paint is distributed on the up roll on your wall, price is being offered on the upside. But at some point, it's going to need to come back down to rebalance areas where the paint didn't really go well on the wall. There'll be little pockets there where the paint wasn't evenly distributed. That's what's happening here. So they're rolling that paint roller back down on the canvas of this chart, only to get to an area where there was richer delivery of paint with this candle here. When it happens, once it does that, That change in the state of delivery sets up the opportunity for new buying because it's filled in an imbalance, and also it's occurring around 25% of the grade of the forecasted price range that should deliver. We don't know, like we're showing here, we don't know for certain it's going to hit this before it goes lower. We don't know that, but it's not necessary for it to hit that to find opportunities. Watch what I mean by that. So we have a mean threshold, buy-side imbalance at 25% grade, and buy-side liquidity left intact. So we know the price is going to be strongly pulled to the upside. It does in the next candle here. Runs up above it, consolidates. Are we anticipating it failing after it goes above these highs? No. Why? Because our analysis is saying that the draw liquidity is up here. So we don't look at all this in here as, oh, it's going to run above equal highs and then break down lower, like everybody on YouTube thinks. So the market does what? It rallies again above this high. Now watch what's happening, folks. This is important. The market trades above this candle's high right there. And immediately it does what? It has a change in the state of delivery. What is it doing? It's offering sell side again. It's going down. What is it doing? Is it coming all the way back down here to run this low out? No, it's not necessary because this low has done something at that 25% grade. It rebalanced and then expanded up and ran buy side liquidity. Not fully running to this level up here yet, or even close to it. So when it starts to dip back down in here, what are we looking for? It's running back into old area order flow, which is this last down close candle right there. Okay, this down close candle right there is a propulsion candle. The market trades back down into this candle here and creates an additional propulsion candle, which is bullish, basically trading down into a previous down close candle. So what we're seeing here and what we're expecting is bullish institutional order flow. That means all down close candles, if they trade back down into them, they should support price and go higher. Every up close candle, which we don't have anything over here in this part of the price action, but if you scroll back, you want to see how price runs through old up close candles, which is breaking bearish order blocks. Okay, again, it's not every up close candle in a swing high makes a bearish order block, not for a short. Sometimes it's just a way of measuring order flow. And what I just dropped there was a heavy piece, so make sure that gets in your notes because you'll hear more about it when you get into charter membership. But we have the market trading at this level here at the order block, and propulsion candle, another propulsion candle, and then rallies up, creates an imbalance right here. Now, notice what's occurring here, folks. This is one of those aha moments. So this imbalance here, does it need to be rebalanced? In other words, does it need to see price come back down here? No. And here's why. Here's where algorithmic theory comes in. At the 50% grade of the potential price swing that we're forecasting, this is generally where we consolidate. It can consolidate longer than it did here and just run out a short-term low or altogether continue. This is where we generally see a run on stops at about the 50% level. If there's an imbalance, they tend to leave those imbalances open. Now again, I just dropped something very heavy. Why would they want to leave an imbalance here just below the 50% level or 50% grade of the projected price swing that we're looking at? Because this is going to act as a breakaway gap or measuring gap. You want to see these things left in price. Now, if you think about how sometimes in my commentaries I'll say, it's better if they leave this area open and don't rebalance it. Oh, light bulbs are kicking off now. Yeah, we're getting to the good stuff. This imbalance should be left intact when we get close to that 50%. Now, if there is no imbalance and there's a short-term low, then around that 50% level, we could anticipate it dropping down below a short-term low, which could have been easily this one, and then that would be a buying opportunity. But if we have an imbalance below the 50% level, I tend to like to see these stay open. Now, that does not mean that it's always the case. Sometimes it will trade back down there. But if it does, I'll buy in there. I'll take a buy in that. Okay, but from an algorithmic standpoint, it's better for it to stay open because it will act rather as a measuring gap or a breakaway gap, and you learn more about that as well. Okay, so Around the 50% grade, it consolidates. You can clearly see that. And then we have another expansion. What are we seeing here? Another imbalance. These will not want to fill. Just like this one down here, we have one here. It's close to the 50% grade. They will act as breakaway gaps. In other words, it's signifying strength on the upside. You want to see these remain open. And again, I'm going to counsel you to think about how many times you've heard me in my commentary say it would be better if they left it open, and then they many times stay like that. And they'll obviously fill at a later time, but not before it trades to where we think it's going to go. You see that? The 50% level of a price grade from an unrealized price run or price swing, this is an area where consolidation can occur. We talked about in previous lessons recently about how some of you were concerned about when can I anticipate consolidation? Well, here's where it usually takes place, around equilibrium. It could spend time in here and then make a false run and then go down below a short-term low. That's something that can also happen. Okay, it can create a breaker forming and then come back down to that breaker later on and use that as a buying opportunity. But we have another order block here. It trades down into it. Are we anticipating it running down into this area here? No, because we're grading the price swing. These areas is where the market's going to refer to and reference its delivery. And in the imbalances, and every one of these order blocks are within a smaller price range. The market does not need to trade back down here or here into this imbalance. Once we get to the 75% grade, it runs almost to the mean threshold of the bearish order block, which is this level here. But it comes back down and does what? It runs into the order block here. All these down closed candles, it trades into that and runs sell side liquidity out. Some of the instances that you're going to see, there is not usually a stop run around that 75% grade. Usually it's just a real quick run to the target. If it does run the stops, then the next price leg that's going, you need to stay with that. And if you're in a trade like this, you would aggressively trail your stop loss, because it's done a stop run here. And if it does fail to get to your target, once it returns, then it will probably seek out areas like this, because we've taken two targets. We have the bearish order block low here, which is a premium array, mean threshold of the bearish order block on the daily chart, which is here. And look at the bodies of the candles respecting that. Yeah, we get a little bit of a spike through it here and a couple little wicks through there. But overall, look at the volume. You don't think that that's being controlled, folks? It's absolute evidence of being controlled. This is just manipulation reaching for the best case exits. That's broker based. But this is the bulk of the volume. That is coming directly piped in from the central bank. It's absolutely controlled. Also, we're running above an old high here. So it's another area of distribution where they're going to do offset distribution of accumulated longs in here, 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 and here. You can forecast buying opportunities around the 50, the 25, and the 75. You're forecasting that. Before it ever gets there, you can anticipate that there's going to be a buying opportunity. And I'm giving you rules about where and what grade offers what type of condition. 50% is usually consolidation. If there's an imbalance below it, it tends to stay open. That's the best case scenario. It can fill it, but if it does go down there, you buy it. 75 tends not to have a sell stop run. It tends to consolidate, create a optimal trade entry type event, and then run to the target. So I could have given you an opportunity where we're giving you the best case scenario using the mean threshold, but I gave you this as a draw on liquidity. Now watch what happens. When it creates this point here and then rallies, you're trailing your stop loss all the way through here. Once it gets above the mean threshold, your stop loss is anywhere in this area here. So what are you looking for then? You want to see it run higher. But if it starts to break down, you're going to get stopped out. Why? Because if it's going to break down in here, it's going to attack the sell side liquidity resting below here. The market breaks down, takes the sell side liquidity out right there. So if your stop loss is trailed here, you gave up all of this paper profit that hasn't been, it's basically unrealized profit. So if you have a live trade on, which you're not supposed to have while you're in mentorship, but if you have a trade on in demo, these profits will be eroded and then they'll attack here. So it's taking you out at a less favorable position exit than that of being stopped out here, because you're trailing it. Once it gets above this high here, and we're at the mean threshold of that daily bearish order block, you have to be cognizant of that and thinking, okay, as much as I want this rejection block to be traded to, I might not be right. So you want to manage your stop appropriately with that in mind, because that could be the catalyst for you getting stopped out and giving up all of this here, which is basically a full 100 pip price range. But once it takes out this level here, watch this unrealized rejection block on this high here, we come back down into the 75% grade of the price swing. Has that objective been met yet? No. So we're trading back down below this low right there. Think about the rules I just gave you. 75% grade generally sees no run on stops. But if it does run the stops, you can use that as a buying opportunity. So you can be buying below here in these down close candles. Order block, sell side liquidity, unrealized objective in a PD array. Nothing really hasn't broken down. Like, this isn't technically a break in market structure. It's just a run on stops. Order flow is bullish. So you could be a buyer in here. Market creates a deeper run into the order block. Consolidation. Look what's consolidating, around 75% grade. And then off to the races again. And then all the way up here. You're seeing the buy program start down here and just a run to this. This is how you start finding consistency. It's not trying to buy it here and hold it up to here. You got to look at every price range. From here and here, there's your range to work within. From here to here, that's a range to work within. From here to here. There's 3 ranges to work in. Experience will dictate which one you work with. I took your attention here initially, and I said that I believe around Christmas time we will be above here. And well, we were, because this is the week of Christmas. In fact, it's the day after, and we're even higher than that. So this lesson highlights the repeating phenomenon around algorithmic theory. Repeating phenomenon is not every time. Okay, it's just the majority of the time. These are the things I'm looking for. These are the things I'm looking for in price action. If I'm watching a price action move on a 1-minute chart and I'm trying to trade inside that range for the session, I will treat this low and this high at, say, for instance, how can I say it? Like, say this is the high of London, and we trade it down into New York, and say this is not a daily chart. Okay, say this is like a 15-minute time frame. Okay, I could work within the range from this low to this high on a 15-minute time frame, and then work with a 1-minute chart, doing everything I just showed you here on a 1-minute chart. I would grade the price swing with this framework here on a 15-minute time frame, and I'll work around all of that if my bias suggests that this is a likely run to take out the London high. So it's not just applicable to 4-hour charts for long-term position trading or swing trading. It can be scaled down to micro market structure and trading 1-minute charts. And when you start studying that, and there's a plethora of opportunities for you to study using a 1-minute and 5-minute chart, all you have to do is go back and look at your session highs and session lows and think about how we were bullish or bearish during that time and study with that context, and your charts will look entirely different to you then. They will start telling you a story that's been hidden from you all this time. But you cannot appreciate it or find it with me just talking about it like here. I'm giving you the way or the process to start seeing it for yourself. But you have to go in, and you go into the charts digging in. You take your pickaxe, your shovel, and you put your miner's cap on, and you get in there and you just start digging around. Something will happen where it'll click. Then you'll start seeing it with a perception that you didn't have before. It doesn't mean you're going to start trading with 100% or even 90%. It just means that you're going to start seeing things in charts more clearly, and then that's another milestone. And it's very exciting when that happens, because then you start forecasting where price action moves are going to occur. Think about it. If you can grade the price swings like this, you can forecast a specific range of opportunities where breakers are more likely. Turtle soup runs on stops as entries. Okay, some of you are afraid to buy sell stops. Well, when you understand this hierarchy and how it works within a range and how you can grade price swings using a draw on liquidity, okay, you're using bias, you're using algorithmic order flow. That's a repeating phenomenon. That's how you know that these things are controlled. It's delivered with a program that is engineered to do things repeating over and over and over again. There's slight little nuances that you need to know, otherwise you won't pick up on it. They got to let some people win, okay? That's a given. But the majority lose. That's the game. So once you know how they stack the deck, and when they run the table out, you can bet only when it's likely to happen. But notice I said when it's likely to happen. That's not the same as saying you're going to win because this is what's going to happen. It's just a probability thing where without these signatures in price, there's no way I could know what was going to happen. And I would fail miserably every single week with you. I would be failing every single week to be able to tell you what the market was going to have delivered in our charts. But you see the opposite of that, because I'm using the things I'm teaching you here and I'm leaning on these things. Now, if these things were not true, if they were not algorithmic, if they were not absolutely controlling price, then I would absolutely be the luckiest person on the planet, and I don't believe in luck. Now, do you need to subscribe to every little pip fluctuation is controlled and manipulated to be profitable? No. And that's what I'm trying to show you here. We're only looking for those choice little setups where everything just makes perfect sense for it to occur. We're not looking for everything in my arsenal to be speaking at the same time. We're looking at specific things that must be there. What is that? Things like I'm showing you here. If I'm not looking at a market maker buy or sell model, I'm looking at graded price swings like this. That right there is another thing I just laid heavy on you. I'm not always trading in a market maker buy model or sell model. Sometimes I'm looking at just a simple price run on a liquidity basis, and I grade that price swing like I'm showing you here. And those are the only two pillars of my trading. That's it. Why is it just those? Because that's how these markets book. That's it. And if it doesn't make sense or I can't see it, if I can't connect with it and see, okay, this is what I'm supposed to be doing right now, I'm not doing anything. And I know why I'm not doing it. And guess what? I'm content. I'm absolutely content with not doing anything when I cannot see a market maker buy model or a market maker sell model or a one-sided price run to liquidity like what this is here. Light bulbs are going on, aren't they? At the beginning of the move, the buy program, as we've been outlining in this lecture series, the idea was that we were expecting price to potentially trade up to those relative equal highs over a longer period of time. So the buy program starts here, and we had obviously some consolidation down here, which is accumulation, and then we have price running through this old high. Now, classic support resistance theory would say, okay, this is an old high broken here, and if price comes back down to that level, I want to be a buyer. And that's what all the books that I bought said. Many times I tried to do that, I lost. This is the reason why what we teach is not supply and demand. It's not classic support and resistance. It's not break and retest. It's none of that stuff, okay? It's deeper, as you'll see. So the logic is this high being ran out. That's fine and great, but I want to know where's it going to go to? Because there's many times the market won't even come back to this old high anyway. But if it does, what am I personally looking for? So the buy program starts here, and that low is the first primary reference point. So we have this low up to this high. So there's our two key price levels. So between this high and this low, we have to run a PD array matrix. So you have to find out where equilibrium is. So we have a very bare minimum of price trading back down to the 50 level. So we were bullish on euro, and once it trades to this price point here, that's indicating that the market is at equilibrium, or while bullish, that is discount. Okay, so at equilibrium or less, and it's bullish, that is a discount market. So at that price level here, we have to start looking at that level and below for all discount arrays. So right away, we have relative equal lows here. We have a buy side imbalance, sell side inefficiency. We have a bullish breaker, last up close candle here, and mainly the imbalance right there. Okay, so watching this low right down here, that's, well, not low, but that high rather, that's what we're going to focus on. That would completely close in this buy side imbalance. So what are we looking at? What are we seeing here? What we're seeing is the initial stages of a high resistance liquidity run, even though the market is bullish. Why is it high resistance? We had a market trade high here, then a higher high, then a higher high. So we had basically a three Indians pattern. All the highs are successively higher. So this was all running out liquidity, specifically seen as a return back to this displacement right here. So it returns back to rebalance, but don't lose sight of this signature here because this is high resistance. For now, just know that this buy side delivery, it's running price higher, going to buy side liquidity here, but it's offering buy side delivery, running into buy side liquidity here. That's why sometimes when you hear me talk about, okay, it's going to run to buy side liquidity, a neophyte trader or someone just watches a hand-me-down video of me talking about runs on liquidity or relative equal highs, they assume erroneously that just because it runs above that, it's running out stops to go the other direction. No. This buy side delivery, it's imbalanced. It's only been offering buy side, so it has not offered efficiently any real opportunity for sellers to trade short or offer in this range between the high here and the high of this candle, what's being highlighted with this blue line. Each high here, we have buy side liquidity here, it runs it. This high here has buy side liquidity, which it runs it as well. And then it breaks down. What's actually occurring there? This is a shift in market structure. It is not a break in market structure. Okay, it's just shifting within the context of an underlying buy program. So this low, when it was broken right there, that shifts market structure to bearish, but only on the near term. Why? So it can go back down below this low to rebalance this buy side imbalance. Before it trades down there, it trades back up into a premium fair value gap. Once it rebalances that, then it's okay to see it trade lower. It trades down into that old high, which is retail resistance turn support. Does it rally? It gets a little sputter there. Then it goes a little bit lower, goes up one more time, and then drops aggressively here. So what is this occurring? It's offering a run on the liquidity that would be engineered right below these lows. But price trades down into the imbalance and then runs higher. Trades above this high. There's your short-term shift in market structure. Now, I don't have it identified like it does here, but this is a shift in market structure to the bullish side. What's different about that? This is short-term down to a discount. This right here is a change in the state of order flow. So there's an algorithmic transition from buy side, the market's offering buy side, and then it goes down into that buy side while it's acting as sell side. Okay, so there's a change in the state of delivery in the price where it was offered on sell side here into an area where it was only buy side. When you have that happen and the narrative is bullish, this is where the signals form. This is how you quantify the buying opportunities, whether it be a breaker, whether it be a fair value gap or an order block. The fact that the algorithm is going into an area where the state of delivery is changing to a previous state of delivery. And it's basically saying this: where there was buy side offered only, when it drops into that as sell side, that is what keys up the algorithm, and it matches up sell side delivery in an area when there was only buy side. Once that occurs and the narrative is bullish, that's when price will change on a dime and start going up. That's how you've been able to see me do these examples where I'm recording and I'm buying and it's turning right on a dime and it has very little drawdown. I'm teaching you that right here. That's what this lesson is. I'm teaching you the internals of why order blocks and imbalances constitute a setup. It's not just it's trading to an old candle. There's logic behind that. And you have to know what it is that it's doing. It's not just simply, oh, it's going back to the order block and we'll just keep it simple. No, the fact that it's got an imbalance here, why does it need to go down there anyway? Because this is efficient delivery of price, and this is what traders are looking for. They are not buying this and then driving price up because they bought it. The algorithm is already going to go up from this point here. Traders on an institutional level may miss this opportunity. That's the part you don't understand. What I'm showing you right here is the internals of what makes that algorithm do what it's doing. How does it reprice higher? Once it does its job of rebalancing the buy side, once it does that, as it goes into sell side. So it's basically saying this: the candle goes up on one singular candle. That's not efficient. But look what's doing here. It's going down multiple times, okay, in a stage where it goes down a little bit, consolidate, down a little bit. It's offering and spending time down there where sellers were being offered the opportunity to get in there. Why? Why would they want that to happen? Why does the algorithm program to do that? Because traders are going to see this as a bear flag. They're going to want to go short. Okay? They're going to sell more. Not just the sell side liquidity here, but they're going to flood the market in all of this because they're going to chase it, thinking it's going to drop lower. So they're pushing all kinds of traders' sentiment into thinking it's bearish, 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 when it's nowhere near bearish. It's all bullish. So you have to look at the contrast between what is the imbalance and how does it trade there. It changes its state of delivery, not a singular one candle down like it does here. It's doing something. And you have to think about, what is it doing? What I just outlined here. It's putting in more sellers. And once it does this and rebalances, the algorithm is not aware of how many people bought or how many people sold. It doesn't know that. It doesn't know your specific stop. They don't have that there's no book like that, okay? The idea is everybody's stop is going to be where everybody's stop is, because everybody's drinking from the same pool and the water's tainted. Price starts to reprice higher and it cues all the traders that will be waiting for this signal here that is aware of what the algorithm's doing. Once they see this break here, that's a shift in market structure on the bullish side. Now, again, what changes? We are now in alignment with the buy program after it's been rebalanced and overcome this impulse of sell side liquidity. It's been flooding the market here on two levels, with buyers trying to buy here and they run at, or they go down and then go down again, rebalancing this buy side area here. So it's not like usually you expect like a single up candle and then over here a single down candle and it rebalances. It can happen that way, and that is usually a consolidated range environment where it'll rebalance like that. But generally a strong trending market, you'll see something like this many times if you drop down lower time frames and you look inside this imbalance. So what may not be showing on a hourly chart here, this same thing could occur in a 15-minute chart where it's drops and then drops again. So it's giving a trap basically for traders that want to chase it going lower, thinking this is a bear flag and they're going to look for it to go down in here or maybe into these levels or this old low. So the market starts to trade higher as a result. And now we have to go back to this old high, which is a high resistance liquidity run signature. So notice what happens here. The algorithm goes real close to it and then drops. So it's a delayed delivery above here, which is exactly what you expect in a high resistance liquidity run. So while this is going up, it's going to be met with a lot of tug of war back and forth before it clears it. Okay? So watch what happens. When you see these failures to go above a high resistance liquidity run and it starts to retrace, your eye should immediately go to wherever there's an imbalance, because that's why it's going down there. Or it's going below a short-term swing low. Well, there really isn't a swing low of any importance here that I like that isn't really pushed to the sidelines because of this clear, obvious buy side imbalance, sell side inefficiency. So you can see the discount fair value gap here. Why is this a discount? From this low to this high, 50 is equilibrium. We were below it and it's rebalancing. So the bottom line is, all we're doing is giving structure and context as to why price should be delivered as it is. But look what's happening. The same thing that's occurred down here, there's a change in the state of delivery. Buy side imbalance, all of this right here is the same thing all this was. This drops down, and the fact that it drops down into this area here, there's a change in the state of delivery. But it's referencing an old delivery where it's been buy side only. So where do the signals form? Where do the order blocks? Where are the fair value gaps? Where's the breakers? Where do these PD arrays? Where are the ones that work? How do you figure out what they are? When the market trades down into it, that sell side delivery of price into a buy side imbalance, that's when the algorithm will reprice and go higher. Now this one overshoots a little bit. Now this tail on this candle, if you go through, I think if you go through TradingView and look at all of the different data feeds, you'll see that this low is different pretty considerably across the board. And if you have live accounts, look at your own low there as well, and you'll see there's a discrepancy between what your low and all these other lows will be, because this is a run on liquidity. That's the part that makes this difficult, because everybody wants it to stop exactly at that high when it's not necessary. All we needed to do is trade into the fair value gap, and we allow for it to trade down below this low. Now that may be more pips than you're willing to assume. Well, then don't trade the 60-minute chart. Wait for it to close it, and then create another fair value gap or a bullish order block on a 5-minute chart or a 1-minute chart, and you'll capture something in there. Then price runs above. The delayed delivery is now ran into buy side liquidity here above this high. So once it hits that, what happens? We refer back to what? This is a high resistance liquidity run. So it does go above it, but look what happens. The market changes its state of delivery again, goes back down into the bullish order block, hits it one more time, and trades to the top of what? The fair value gap. They do not expire outside of the range of the ICT data range. That's how I stop looking at them. Now, if they become sensitive again because of price action and recent delivery, then I'll start following them if they're outside of 60 days. If they're older than 60 days, but they're starting to show sensitivity again, then okay, fine, they're going to be reclaimed. But I don't like to look at a PD array above 60 days and expect a lot of sensitivity. It can happen, but I don't choose trades around that. And that's why we have ICT data ranges, 20, 40, and 60-day look back. But the fair value gap, it trades till here, finds the support with an order block, optimal trade entry. So what's the narrative still? Are we bearish? No, we're not bearish, we're bullish. So the market starts to deliver price on the upside again. Goes above this short-term high, and then what happens again? Another retrace. What's it retracing to? The order block, which is that down close candle right there, and that fair value gap. The state of delivery here is buy side only. What does it do? It trades down into it. The sell side, at the time it trades into the imbalance of the buy side, at that moment, the algorithm changes gears. It shifts. It changes its state of delivery. It's not buying pressure. The market makers were turning price at that. They stopped offering lower prices because they knew how far they were going to take it down to. It was all manual then. Everything was manual. It was a group of men that would literally sit around and say, okay, we're not going to offer any more pricing lower. That's it. And then they would start offering prices higher. And then you, as a trader, see that and say, oh, they're bidding it up. Who's bidding it up? The traders, they're buying it up. That's not what's happening. They're controlling it. Whose storehouse is this? The market maker. Well, if we're talking about currency, who's the storehouse owner? The central bank. So whatever price they offer, that's the price feed that everybody deals with. Okay? So if you have a broker or a dealer, that desk has to work with the price that's been given and piped into them. They have no control over where that price is going to go. The only control they have is the spread. They can make that as wide or as narrow as the law will allow, but they have no control over the delivery of where that price is going to go ultimately. This is what I'm teaching you here. We have consolidation here. Market runs up, and we have a breakdown. This is a market maker sell model. What? Yes, this is a market maker sell model. But remember, the sell model can sometimes reaccumulate over here and not run out the original consolidation. Oh, that's all part of this same fractal as well that supports the narrative. But then you have this market maker buy model. Consolidation, breaks, returns to consolidation, smart money reversal, low risk buy, reaccumulation, another level of reaccumulation, and boom, clears the original consolidation out. Everything will start to dovetail once you start putting the pieces together modularly. You have to do it bite size. You cannot eat the elephant with one gulp. You got to take one bite at a time and expect to spend a lot of time. You're learning the most difficult thing on the planet because you're standing in front of yourself saying you can't do it or it's too hard. But you have to do it every day. Go into your charts, really annotate them, study them, think about why would it have done something like this, and why is it doing what's doing over here? What's it trying to do? Okay, and then look for when the state of delivery is changing. Okay, when it's opposed to the underlying narrative, it's bullish back here. It's bullish right here. It's here and here. Every single time it's trading down into an area where there was buy side delivery offered, and the delivery is changing its state to sell side and overlaps with that moment when it was buy side. That is efficiently balanced. That means at that moment, that's when you anticipate the algorithm changing gears. Not buyers are coming in or sellers stop losing momentum or start losing momentum on the sell side and now buyers take over. That's not what goes on. That's not how this works, folks. You have to have a narrative. What is it doing? Is it going to go higher or is it going to go lower? Why? What makes it bullish or bearish? That's what I teach you. I teach you relative to that weekly chart. Is the next weekly candle going to expand to the upside or is it going to expand to the downside? That's your number one question. What's going to happen on that weekly candle? You're not predicting the close. You're not trying to predict exactly how high it's going to go. You just need expansion. Okay. Once you have expansion, that means opportunity. And you work within that bias. And if you're wrong and it doesn't go in that, then you're wrong. It's nothing wrong. It's not going to kill you. But once you have that narrative, you stay with it. And you look for all of these little pieces of the puzzle because they're not going to hide it from you. They can't. That's the beautiful thing about this. When you understand the state of delivery and when it changes and then it overlaps where it was a previous state of buy side and it offers it into sell side, as it's trading down like that, every retail book out there says nothing about buying when it does that. They like to see it when it's already turning, okay, or they're looking at an indicator. And once it goes down here and hits this, there is a bullish divergence. If you look at an indicator right there, that's when they work. But it's not because the divergence is there. It's because the narrative overlaps with what I'm showing you here. The delivery of price controls everything. And it's hinged on time and price. Once you have that and you understand the states of delivery where it's buy side then changes to sell side, when you're bullish, that's where the signals are going to form. Because the algorithm will turn on a dime there, like it does here, and here, and here. None of that harmonic, none of it had this level of precision. But you're learning the highest order of precision there is in these markets because you're learning exactly what makes these algorithms turn and when they reprice and how they should price aggressively, one-sided, or how they do it in a sputtering context like this. I'm teaching you how these markets create these choppy but eventual run through. You never learn that in a retail book. You never see that. Folks, I got over 2,000 plus books, and I'm telling you, I've never, ever, ever seen anybody teach the idea of a high resistance liquidity run. It doesn't happen. It does not happen. But you're learning that. What's the benefit of that? You can trade in them. But if you can understand also what they look like here, while they're still profitable, it's better to focus your time and energy on low resistance liquidity runs because you're going to get that immediate feedback. You're going to get that easy run to your target. Doesn't mean you're going to 100%. It just means that you'll find in contrast that that's the easier way of trading. And by knowing what these trades look like, you can filter out your expectation of fast runs while it's like this. So this is a 15-minute time frame. So my chart is trained in on a lower intraday chart, but using the context derived from that higher time frame daily chart. So we're looking at the section that was referred to at the beginning of this teaching series on algorithmic order flow and referring to the buy program. But right away, I want you to take a look at this level right in here. Stops, retraces, consolidates, drops once more, then rallies away. The buy program begins here, but we wait for an initial displacement. We have it here. I mentioned on the previous discussion how we ran buy-side liquidity there. So there's a change in the state of delivery. Once price starts going lower, the state of delivery is on sell side. It's dropping down until it gets to a period of old buy-side delivery, which is this imbalance right there. So notice it does not completely come down into that last down close candle here. So the state of delivery in this run is buy side, changes to sell side in the bullish context. So your framework is watch this imbalance, watch the last down close candle. So think about that paint roller analogy. Paint is applied and needs to come back down, starts to go back up, but doesn't completely close that in until we get down into that last down close candle, and it trades to it here. So what's occurring here is the imbalance is what you identify as the stage. Then you watch to see if it has any sensitivity once it comes back in here. And does it have any sensitivity? No. It's lethargic. See how it's, yes, it's going up. I mean, if we were going to be splitting hairs, yes, there was a small minor reaction there. But is it dynamic like this or like this, where it's showing a willingness for the algorithm to want to reprice away from it? No, we're not seeing that. So when we start seeing these things like this algorithmically, you should be identifying that as, okay, it's likely to still come down here and close in this unfinished business. So the last down close candle, that's your bullish order block. When it trades to that, yes, then you'd anticipate the algorithm to start spooling and moving towards buy side liquidity here. Now, once buy side liquidity is traded to during buy side delivery of price. Now I'm going to say that again. Above this high is buy side liquidity resting in the marketplace. It's orders. Okay. Buy side delivery is when the price is going up. The algorithm is offering it on buy side. So it keeps going up, 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 up. Notice that when we trade to buy side liquidity, there's a small little imbalance right in here. So that small little imbalance while we trade into the buy side liquidity, that's all that's required to trade back into and rebalance. That's all that's necessary. Now, this is when you see those instances of classic support and resistance theory supposedly working. But I'm going to show you in this teaching here why it doesn't work like that and when it's likely to fail and how you can use the real insights with the algorithm. So we have the imbalance here traded to, and then we have another measure of displacement on the upside. We create relative equal highs, which builds in and engineers more buy side liquidity. Traders are going to look to see this as a shorting opportunity, especially with this drop down here. Now, I want you to look at this area right there. Now, classic retail traders and support and resistance theory says that with this high being broken here, we want to see it trade down to that, and then that'll be the buy, or that's where the market should turn. I want you to look at all of this price action in here. And algorithmically, I want you to think about what IPTA would need to do to reprice efficiently. We have a run here that fails to go above this high, and then it declines. It trades lower. So we have a breaker. These up close candles, that's your bullish breaker, and it has an imbalance with institutional order flow entry drill with this candle's low. So we trade back down through this old high, which would be expected to be reasonable because we have a breaker, we have an imbalance. It trades back down into that bullish breaker, institutional order flow entry drill, and it trades into where buy side was offered. In other words, this is buy side delivery. The price is being delivered on the upside. When the market trades back down during sell side delivery, it changes its state of delivery when it enters an old area of buy side. So there's an overlapping of where old delivery was bullish. If it trades back down into that with sell side, that's when you anticipate the algorithm changing its state again back to buy side. That's the real quote unquote dynamics of why the algorithm is doing what it does and why order blocks and inefficiencies actually are of any importance. But the factors are, as I'm outlining here and in all the previous discussions in this series. Then we have what? Displacement again. Institutional order flow entry drill trades into it here, another level of displacement on the upside. Moving forward a little bit in price, we still have this imbalance here. So we had institutional order flow entry here, profitable, but for a longer term position trade or a longer term swing trade intraday, it may require to trade back down into this imbalance. So we know the imbalance range and its premium level, its discount level, and in the middle is consequent encroachment. Trades to it here and offers another level of distribution. Now in this price run from here to here, I want you to think about what imbalances reside still. We still have the bottom end of this, but we have a lot of sell side liquidity resting below here. And notice how price was delivered. We have buy side, then it trades at the close. Buy side, and then buy side, one single pass in here. Then we have buy side offered after it trades down a little bit and rallies here. And then this candle rallies again. So there's a lot of give and take back and forth in here, except for this small little area of inefficiency right there. That is your bullish discount fair value gap. Okay, it's a small little capsule of buy side imbalance. That is all that's necessary for the algorithm to come back down from this high to this low, trading back down into what would be considered a discount market. So at a later time, this is going to be influential if we lose this low. Why this low? Because if it came down here and didn't fill it entirely on this imbalance, and then it came down here and rallied, it won't come down here just to rebalance again to go higher. Why? Because it's underlyingly bullish, and it's going to probably need to go, if it goes back below here, it will look for a deeper pool of liquidity so that way it can buy from willing sellers at a lower price. Remember, there's traders that are long and they're trailing their stop loss. When the markets are here, their stop loss is going to start pulling right here. So do we just expect it to go right to that level here or to the big figure? No, we can anticipate a run to the big figure, but once we trade to a big figure, what's the protocol there? It can go 10, 20, 30, 40 pips. This is that imbalance. We just moved the chart a little bit forward in time. Notice that we had buy side liquidity traded to it here, and one more time up in here. We'll get into this area in a moment, but I want you to take your attention to right there. So we have that small little imbalance. We extend that out in time because you and your development will not know exactly when it's going to trade to that level, but you want to have it on your chart should it trade there. So we had a run above buy side liquidity here. Then the change in state of delivery is on the downside. So sell side is being offered. And then we have a break in market structure. This break in market structure after, now this is important folks, algorithmically, if we trade to buy side liquidity like this while we're in a bullish market environment or buy program, if we trade the buy side liquidity and then the market breaks down, it takes out the run that led to that buy side run, taking out liquidity. If it breaks that, then this becomes a bearish breaker. We trade up into it here with an imbalance. Does it completely close it in? No. It goes back to a period of buy side delivery. See these candles here? That's your bearish order block. That low with the imbalance, which is consequent encroachment as well, inside of the bearish breaker. Here, here, order block. There's your turning point. Runs, if it breaks below here, remember the protocol would be it's going to attack the sell side liquidity. To do that, it's going to reach for what? It's going to reach for this level here. Why would it do that? Well, if you look at the range between that low and this high now, here's 62% retracement, 79% retracement. That's optimal trade entry, but we're more specifically below the 50 level. Why go below this low, Michael, for sell side liquidity? Why not just this one? Because this would take us to a discount or at equilibrium. So at equilibrium, so trading back to discount or to equilibrium in a bullish buy program is the same thing as saying it's a discount, but not just to that level. We want to look for a PD array. So the PD array is the fair value gap there. So we're going to identify this level here with these green dashed lines. All that's doing is highlighting the fact that this is optimal trade entry, 62 and 79 respectively. But specifically in a precision-based perception, this is the actual PD array we're aiming for within the optimal trade entry. So it's not just, okay, I'm looking for an optimal trade entry trading at 62% tracement. We're looking at what specific imbalance, or what PD array in this case, does it need to trade down to for a discount? And will there be precise delivery to that and sensitivity after it's traded to it? And again, focusing here for the imbalance, breaker, and again, expecting price to trade below here. And here's that breaker, trades to, and then we trade down, consolidate, and go right into that fair value gap. There's the levels, consequent encroachment into optimal trade entry. Is there sensitivity there? Yes. What's happened here? We ran to another level of buy side liquidity. So we have a change in state of delivery. It starts going down. So we have sell side at a time when we're inside of a larger time frame buy program. Don't lose sight that this 15-minute chart is going back and forth, up and down. The ebb and flow is not as critical as understanding what the higher time frame bias is during the same time period. Again, if you're just watching this video and you have not watched the previous 3 videos in this series, then it's not going to mean as much to you, because you have obviously the higher time frame levels in mind in addition to what's being shown here. Otherwise, I would have too many things on the chart. But I want you to go and look at your chart here as it trades down into this fair value gap right there. Where is this occurring in the context of the daily chart on Eurodollar? And you'll see that you're trading down into a bullish fair value gap. That's a discount on the daily chart. And this is actually institutional order flow entry drill on a daily, not just focusing on what I'm outlining here. So I'm bringing everything together that frames and models the buy program and where the actual turning points IPTA will do and how precise it is. But this buy side delivery here, and it starts to drop down, what is it doing? It's running short-term sell stops and returning back to bullish breaker. There. Consolidates and then runs. Once it takes this high out here, another level of buy side liquidity, we can start seeing all the sensitivity and returning back into the imbalance right there. So this price run here starts the next level of advancement to attack this high. Scooting on over in the future, we have the low still, and we run up to this level here, and then this here. This displacement is taking traders out that are trailing stop loss orders as it runs higher. Look at this low to this high. Imagine, you don't need a fib to do this. Imagine where 50% would be. From here to here, where's half? And what would reside just at 50% of that range or below it? We have an imbalance in here. We have sell side liquidity here, and we have an order block, the last down close candle right before this displacement on the outside. So we have the market run down into the order block. A little excitement on the downside, but that's fine. In here, I want you to take a look at what's going on. We have the high and price running to and through. So why doesn't it just go back down like the previous example where I was saying that old highs isn't the be all end all for buying? If it breaks above old highs, it's not going to act as support all the time. And it's not always the case when we have a little imbalance here that it would trade not just to this old high, but down to this imbalance and then go higher. That's what you would reasonably expect. This is not what the algorithm does. You have to consider what has just transpired. The algorithm has traded down, and the change in the state of delivery for stop running sets the tone for not needing to come back down to this, but needing to come back into this displacement. So think about how we started the buy program, and we were looking for certain things to be there. This creates like another minor or smaller buy program within a larger buy program. So it creates another fractal. So the change in the state of delivery here starts with the stop run. This is important because the fact that we ran stops on the sell side now indicates that it does not need to come back down in here again. So when it runs higher and takes this high out, when it retraces lower, we don't look for just imbalance right in here. We look at the breaker here, because why? The context is a stop run just took place. So don't think that it needs to come back below this low again, or that it needs to just only trade here. Anticipate it trading to the breaker and any imbalance that starts here with the last down close candle. So think the same thing that started the buy program initially in this teaching, in this very video, and how this is very close to what was the beginning of the buy program. We wait for that displacement, then it comes back down into the last down close candle. Everything's repeating here within the larger context of that daily buy program. The market trades to the order block here and runs, but look what it does. It just takes out this high on a very shallow basis. That's indicative when you're bullish that we're going to retrace again, and the only thing you need to look for is not a run back down below this low, because this only referred to this order block after the stop run. So neither this low or this low needs to be traded through. So the logic algorithmically is, okay, this low's in place. It's not likely to be, if it takes this low out, we have a deeper retracement in order. And then if it goes below this low here, it's not just taking this low out, it would probably run for these relative equal lows over here. And then that would upset, in my opinion, the buy program. So you would have to move to the sideline. Now, I just gave you a mouthful, but I'm telling you exactly what the secrets are on how to work within the algorithm within a buy program. Everything I'm saying here would be reversed if it was in a sell program. But back to this shallow run initially above this high. If it runs here and it starts to drop from here, where is it going? It's going to an order block or an imbalance. We have both here. We have a small little fair value gap and the last down close candle within this run. So this is all that's required. So your eye should go right to that. There's your order block. It trades down to it here and then starts to build another price run higher and more meaningfully trades through these highs. Moving on into the future, keeping everything as it was in the previous slide. No real imbalance here. It just trades to it, finds some support. This is your classic support resistance idea. There is no imbalance that it needs to drop that down into. It's also a run on sell side liquidity here. So there's no necessity for it to trade back below this low now because it's already done its work by taking stops. So when you go through your charts, you want to do things like this. You want to annotate your charts, and the things I'm saying verbally, you would actually type those things out in annotations. So that way when you're looking at your charts, if you look at charts that are like 2 years old, 3 years old, or even a couple days old, you may have forgotten what the context was around that specific element in terms of like an intraday chart. And you also want to include on your charts the higher time frame narrative. So somewhere in the chart, you would have an area where like daily perspective or daily chart perspective or higher time frame perspective, you would remind yourself of specific key points in price action as to what frames or models this specific buy program and why it's important for that particular fractal that you're logging and annotating for your study journal.